What's up, YouTube? Eric here, Mr. Fired Up Wealth. Let's talk today about recession-proof stocks. Now, this is something that's been requested several times over the holidays, and I'm going to cover 20 stock picks today. Before I do that, though, I want to talk about the sectors that generally hold up well and some factors to consider before you buy these stocks. A lot of them have run really hard, and we're going to talk about the reasons why you may or may not want to buy these for your portfolio. So whether you're into these type of companies or not, I think this video is going to be very helpful for you to understand some of the macro and what's going on here and just portfolio management longer term. So we're going to cover recession-proof stocks. I'm going to talk about the sectors here and give you 20 individual stock picks. So what performs well in a recession? What sectors and industries? Generally dividend stocks. So people are going to want to get paid a dividend while they wait, and the higher yield generally does well. We're going to talk more about that here in a second. Profitable, so PE ratios, lower valuation, that's going to be much more in fashion than hyper growth stocks, of course, that don't have any PE ratio, that trade at high price to sales. These are going to be more popular. Now, with that said, a lot of people have already piled into those names, okay? So we'll talk about that here in a second as well. So healthcare stocks generally hold up pretty well. You think of like pharmaceutical companies, United Health Group, things like that. Consumer staples, of course, people still have to buy their groceries and their laundry detergent and things like that. We'll talk about some companies that fit in there. Utility companies, you still need energy. You need to heat your house in the winter. You know, whether you've got money or not, those companies typically do well and they pay a dividend. A lot of them are higher yield. So I'm going to cover a couple utilities today. Budget retailers, think like Dollar General. If you're on a budget, you're trying to pinch pennies, you're going to go to some of those budget retailers. So I'll cover some of those. And then cybersecurity, and I've got an asterisk. So the reason for that, we don't have a ton of data about cybersecurity companies. It's a newer sector, right? So we don't have 20 years of data on cybersecurity. The idea behind cybersecurity, and not all cybersecurity companies are going to fit into this. So the hyper growth stocks, the super high EV/NTM revenues and price of sales, that's not necessarily going to be in fashion still. But the idea behind this is that cybersecurity have more insulation because the CIO of an IT organization is going to need cybersecurity, whether the market's good, bad, or indifferent, whether the economy is good, bad, or indifferent. They can still get impacted, okay? So this is going to be one that's probably the least recession-proof out of these sectors, but I do have one stock within there that I'd like to talk about and give you some reasons why I think it could be an opportunity in a recession and maybe hold up a little better than some of the other names out there. So things to note before you invest in these type of stocks. The market's forward-looking. So the market's already bought a lot of these stocks and it's run the prices high. Some of these are trading at historically high PE ratios. You have to be careful chasing. You chased growth in 2021. Now be careful doing the same mistake chasing value. So I want to disclose that before we go on, but I'm still going to give you 20 stock ideas. I'm going to give you some price points on some of them. We're going to talk through it. Many of these names have held up well, and many of them have run pretty hard, and they're not necessarily attractive or buys at these levels, okay? Earnings matter. Earnings are going to matter in 2023 more than ever, right? They're going to be very important. So the reason I put this in here is if someone has a bad, earnings miss, the company is not necessarily bulletproof. When we say recession-proof, nothing's completely bulletproof or recession-proof. And there's a lot of macroeconomic factors that go into this. And it doesn't necessarily mean that these companies can't have an earnings miss and drop after earnings, right? Investment style and horizon. So are you investing for 10 years? Are you young, focused on growth? What's your style? If you're a growth investor, don't go sell your growth stocks and then switch to dividend stocks. Now, with that said, I like to teach balanced portfolios, having some dividends, having some growth, having some specs, some ETFs. So it's not bad to look at some of these companies anyway, at least have them on your radar, especially if there is a sell-off, you can add some of these names. Rotation and cycle. We saw the rotation from growth to value. That's going to happen again at some point. And I don't know when. Maybe it's end of 2023, maybe it's 2024, but you can get hurt on that rotation cycle again. If you buy these at historically high levels, and then all of a sudden everybody sells those from underneath you to go chase tech when the bull run starts, you can get hurt both directions. So if you're buying these stocks, you're probably holding them for 5 or 10 years to bake out a blueprint, not necessarily just trying to swing trade them or something like that. So keep it in mind. It'll diversify your portfolio having some of these stocks, different sectors outside of IT, some dividends for compounding, the eighth wonder of the world, and so on. And the yield is going to pay you while you wait. So if you're reinvesting dividends, even if you buy it at a little bit higher price, the idea is if you hold it 5 or 10 years, it's going to compound. I did a video yesterday Covered my top 10 stocks by concentration. My number one is Microsoft. I bought it over 10 years ago, let the dividend reinvest. My yield on cost is almost 9%. So these can be very powerful companies, especially if you can find the DGIF type companies within the DGI sector. And DGIF just means you're focused on total growth, growth of the stock price, as well as growth of that dividend. Bonds are an alternative at this point, guys. So what this means is as the bond yields get higher, if 10-year treasury is at 3.5 or 4%, it gives some investors, especially if their job is just to conserve capital and maybe they're older and they've already generated their wealth and they're just trying to preserve it, conserve capital. Well, a bond is going to be very attractive at 3.5 or 4% versus a dividend stock that pays 2 or 3%, especially if they're tax-free. So keep that in mind. Bonds are now an alternative, and as those bond yields go higher, it's even more and more attractive for certain investors. All right, let's jump into this. I'm going to cover 20 stocks in various sectors that we discussed earlier. They're not in particular order. Costco is the first one I want to talk to you about today. The ticker is COST. Now, this one's going to pay you about a 0.78% dividend. I've owned this stock long, since 2015. It was funny. Somebody yesterday said, you should sell your tech stocks and buy Costco. I'm like, well, I've actually already bought Costco in 2015 and I've done very well on it. I like to have a diversified portfolio that includes stocks like Costco as well as those tech stocks. Now this thing, as I mentioned earlier, some of these are expensive. It's a 34.5 P ratio. Now with that said, the 52-week range, it was $612 and it's $456. So will this hold $450 and run a little bit higher? It could. And this could create some diversity in your portfolio. This is going to be one of those consumer-focused budget shopper type stocks. It's a consumer staple. It's kind of a cross between budget shopper and consumer staples, because I'm going to go buy my groceries at Costco, whether the economy is good, bad, or indifferent, and a lot of other people will. So it's not that they can't be impacted, but they're more recession proof than the average company out there, right? But check out Costco, guys. You know, they've got the recurring revenue from the membership fees, which I really like. They're continuing to expand internationally, and it's a great company, strong balance sheet, Costco. Now, before we go on, guys, do me a favor. I am really trying to grow this channel to 40,000 subscribers for 2023, and I need your help. Subscribe to the channel. I'm bringing you free content. This is my second video in 2 days. I'm going to keep bringing the heat in 2023. Make sure you click the bell to get notifications. So if you're a subscriber already, click the bell. So that way when I create a new video, you get a notification. You won't miss the thing. You can jump in and watch the video as soon as it is published. So subscribe to the channel, click the bell. Appreciate your support, guys. Now, some of these stocks will be obvious, others maybe not so much, but Pepsi has to be included, ticker PEP. This is a 25.62 PE ratio, and it is close to the 52-week high. It was 186. It's trading at 180, pre-market at 181. This is going to pay you, though, over a 2.5% dividend yield. It's a $4.60 annual dividend, 2.54%, another consumer staple, Pepsi. Now, in the beginning of the video on the slides, I talked about cybersecurity as a possibility. The one stock that sticks out to me, and I don't own this, it's on my watch list, and I'd like to add it to my portfolio. I think it's attractive under $140. It could certainly go lower. This does not have a PE ratio. It does have some of that SaaS recurring revenue type model. This was a $213 stock at the high on the 52-week range, and the low is $136. So I think it's getting attractive valuation-wise, not that it can't go lower. I think this is one that could have some insulation when you think of, CIOs are not going to cancel cybersecurity, whether the market's good, bad, or indifferent. They might not have the growth that they normally have, so that is a risk. And you could see a stock like this sell off in earnings. That would be an opportunity, I think, to add the stock, especially if it dropped down to $120 or something like that. So keep this one on your radar. Palo Alto Networks, the ticker is PANW. Now, this is not a stock that we talked about in the beginning. We didn't talk about banks. And honestly, banks can do bad in recessions because you got to think about people who are borrowing money. There's going to be higher defaults. Now, with that said, higher interest rates, higher bond rates, that's going to benefit a company like Bank of America, and it pays you a 2.65% dividend yield. It's a 10.49 PE ratio. So this was $29.31 on the 52-week range low on October 13th. It was up as high as $50 in February of 2022. So this could go back in the 20s. I think it's an opportunity maybe to accumulate if you want to diversify and get some banks in your portfolio. I like it because it has that higher dividend yield. So it fits on that dividend yield part. But as far as a recession-proof stock, banks generally aren't in here. There could be more pressure, but I like this stock as a long-term investment just for some diversity. Bank of America, ticker BAC. Now, this stock is very expensive, so I don't know if I'd necessarily go buy it right now. You know, it was $117 in May 20th, 2022, and the high on the 52-week was $106.77. This is Walmart. P ratio is almost a 44. Now, I could argue that there's stocks like Tesla that might be more attractive, even if the PE ratio compresses more than buying a Walmart. But it does pay a 1.57% dividend yield. It's a consumer staple, and it should hold up fairly well. I wouldn't be surprised if you saw the stock back in the $115 range or something like that, and that would be maybe an opportunity to add it. But I think it's important to at least note Walmart generally is one that holds up better during recessions. Again, the market's forward looking, so they've already bought the stock in preparation for recession, and that's why the P ratio is a 44. So I don't know if I'd go buy it today, but definitely put it on your watch list. Walmart, ticker WMT. Okay, so this next one does not fit into a sector category because it's semiconductors, information technology. But the thing about it is you think of high quality balance sheets, nice dividend yield. This pays a 3.29% dividend yield. It's a 21 P ratio, so it's fairly attractive. Broadcom, $559. They're trying to acquire VMware, so there's some risk with that. And it was as low as $415. I like it much better in the $400 range. With that said, it was a $672 stock a year ago on January 4th, 2022. So, you know, this one, I think another one you put on your watch list, and if it kind of pulls back, it'd be an opportunity under a 20 P ratio. But I like this one as a long-term investment. I think longer term, if you're holding this 5+ years, it could do very well, and it's still attractive even at a 21 P ratio. Check out Broadcom, ticker is AVGO. Now, before we go on, guys, I need to announce that this video is sponsored by The Motley Fool, and if you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, they don't tell me what videos to make, what stocks to cover. They're a great partner, and they allow me to bring free content to YouTube for you at no cost. And so check those guys out, guys. All right. So you can also join our private community and our private Discord. That's patreon.com/firedupwealth. So this next one we've not talked about on the channel ever before, I don't think. It's O'Reilly Automotive. Now, this does not pay a dividend, and it has a 25.76 P ratio, and it is close to a 52-week high. It was 870.92. It's trading at 849 pre-market. The reason I like O'Reilly Automotive here as a possibility is because I think that cars, when you think of people buying new cars, if they get squeezed and they don't have money, they're going to buy less new cars. And so what they're going to do is they're going to fix their current car. And in a recession, a lot of times stocks like this, O'Reilly Automotive, they do fairly well because more people are choosing to keep their current car and fix it up versus buying a new car. Check this one out, guys. Ticker is ORLY. Now, alcohol is generally going to be recession proof because people might even drink more in a recession when they're depressed. I know that sounds terrible, and you might not invest in stocks like this because it's a sin stock and it might be against your DNA and what you believe in, but I want to cover it anyway. 52-week range was 160 in the low, 223 in the high. It's $177. It's actually down pre-market. It does pay you a 2.037% dividend yield, a 26 P ratio. They offer scotch, whiskey, gin, vodka, rum, ready-to-drink products, so on and so forth. Headquartered in London, United Kingdom. Explore this one. There's a lot of brands you probably know that these guys have under their umbrella. DEO. So we already covered Pepsi, and obviously Coke is going to be another consumer staple that generally holds up well. Pays you a 2.76% dividend yield. The PE ratio is even a little higher than Pepsi. Pepsi is closer to 25. This is closer to 28. So again, maybe not the best buy right now at $63, but this is one that generally holds up well. That's why the market is forward looking, and you know, it's gone from $54 to $63 in a pretty short period here. So again, I'm not chasing it right here necessarily, but it's one to at least mention in a recession proof type video. Okay, so Coca Cola, ticker is KO. Be careful with these. Pepsi's more diversified. It has a lot of the snack products. They own things like Quaker and Gatorade and lots of different Cheetos and Fritos and all that. Coca Cola, I think, is maybe less diversified. I know there's some activists and investors. Bill Ackman was talking on Twitter yesterday about how he thinks Coke and Pepsi are the devil, and maybe he's shorting those. There could be lawsuits for health reasons, things like that. So this is another one you might want to avoid altogether. If you own this one for years, it's done very well for you. I'm not saying I'm going to go out and buy it at $63, but it has to be included in a top 20 list because it is really the epitome of a moat and a consumer staple type of a stock, Coca-Cola. So I've covered this on the channel before. Back in 2019, I did a top dividend stocks, top 60 dividend stocks to buy, and I covered different sectors. And under consumer staples, this was one of those stocks that I covered. It's Church & Dwight. So you think of like Arm & Hammer, they've got toothpaste, things like that. It's going to be a consumer staples type stock, an interesting one. They do laundry detergent and things like that. Again, expensive, 27 P ratio. It does pay a 1.3% dividend yield. This is one that I would consider, potentially a DGI, DGIF type holding for long term. It's $80 right now and 61 cents. 52-week low was 70 and it was up $105, so over 20% higher on April 27th. So it's not terrible where it's at historically, but still when you look at the P ratio 27, one to at least put on your radar, CHD. Now this is a stalwart for many DGI investors. My wife owns this in retirement, Procter Gamble. It's $150 right now a share, 26 P ratio, again, kind of high. Pays you a 2.4% dividend yield. There's not a lot of growth there, not a lot of organic growth. It's just kind of slow and steady. But it's one that's going to be one of those stalwarts in your portfolio that you can rely on. It's probably always going to be there. People are going to buy the products at Procter & Gamble. So they own all kinds of different stuff if you look into them. But ticker on this, guys, is PG. We've talked about Kroger recently. I know they're trying to buy Albertsons. There's been some back and forth on the news. It got down to 41.82 on the 52-week low, 62.78 on the 52-week high. So it's closer to that lower side here at 44.58. A 14 P ratio, much more reasonable than some of those other ones we've talked about. Pays you a 2.3% dividend yield. You think consumer staples, grocery, it's one to include on the list. Kroger, ticker KR. This is another stock. Again, I don't know if I'm going to go buy this at a 33 P ratio, but it has to be included on a recession-proof stock. Obviously, people know that, and they've already bought the stock in preparation for 2023. It's a 33 P ratio with McDonald's. Pays you a 2.3% dividend yield. I think if you own McDonald's, I've always said it's kind of a real estate play. It counts as consumer discretionary. You think of, budget fast food type of a company. But they're not going anywhere. More than likely, it's going to hold up, fairly well. It could sell off. $217 was the low on March 10th. It's $263. So you probably want this thing to pull back under $250 if you were buying it. But it is one that has to be included on a list because when you think of top recession-proof stocks, this one's always going to come up. McDonald's, ticker MCD. I do like this stock a lot, and I've covered a few times on the channel. It's Casey's General Stores. If you're in the Midwest, you know these guys. It's one of the top pizza chains in the world because they sell so much pizza. It's a convenience store, consumer staple. It's Casey's. It's a DGIF play. So this is going to be more of a growth play that pays a small dividend. It pays you a 0.67% dividend yield. P ratio is a little higher than maybe you wanted at 20, but not as bad as some of these other ones. With that said, 249 was the high December 8th. It has pulled back at 224. I'd prefer this stock under $200. I had it at one point around 190 and it ran over $200 and I sold it and took profits. But I do like this longer term. The growth is pretty solid and people are, in a recession, yes, people might drive less, but they're still going to have their basic necessities. People are still going to buy cigarettes. They're still going to buy their energy drinks. They're still going to, need gas, right? So Casey's General Store, I think, is one that could do okay in a recession. I want to include on this list. Ticker is CASY. We've covered this one before on the channel as well. Flowers Foods. Now this pays you a 3% dividend yield, 3.06%. Another P ratio that's kind of high, guys, around 28. And this is close to those 52-week highs at 30. But you can see the range is pretty tight between $24 and $30. So if you're looking for a 3% dividend yield type stock with some growth that might do okay if you're holding it for a couple years, this one probably is one that would fit the bill. You have to be careful chasing a lot of these at these prices, like I've said many times in this video. But I do like this company longer term. It's Flowers Foods, ticker is FLO. So this is an obvious one. You think of the budget conscious consumer and consumer discretionary, Dollar General. And people, are tight on their budgets. They're going to try to save where they can, and they're going to go to dollar stores. So Dollar General is one to take a look at. It pays you a small dividend, 0.89%. P ratio is a 24. Now, if you look at the 52-week range, it was much more attractive below $200 at 183 in May. The high on this was 262. So this one's a little bit more reasonable than some of the other ones we've looked at a 24, but I'd still prefer this thing closer to 20 or less than a 20 P ratio. But Dollar General always comes up on those lists, so I had to include it on here. Ticker is DG. So this is one that I've owned for a while, and it's always controversial because people say, well, if we go into a recession, then no one's going to buy new microwaves and new dishwashers and refrigerators, and that might be true. But what happens oftentimes when you go into a recession and the housing market kind of gets hit is people, kind of like cars, they're going to stay in their house and they're going to fix it up. They're going to remodel. So Home Depot generally does see some business. It kind of shifts. It's cyclical with their business. They might sell less, dishwashers and refrigerators, but they might sell more new kitchen sinks and countertops and things like that. Now, with that said, this is one of those that, again, it's very polarizing. Some people think that a company like this is not what you want to own in a recession. But I like this company, and it's still attractive at a 19P ratio, pays you a 2.4% dividend yield. I've been in this stock for many years. I think it's a high quality company. You can also look at Lowe's. They're very similar companies. This was 264 in the low and 52 week, and it was 417. So, under 300 would be ideal, but it has come back a lot from its highs at 417. It's one I wanted to include, gives you a little diversity within consumer discretionary and housing. Home Depot, ticker HD. Now, before I continue, guys, I want to remind you, I did a video yesterday. It covers my top 10 holdings by concentration. That's free on YouTube, top 10 on YouTube. Go check that out. And if you're interested in seeing my entire portfolio, you can see all 59 stocks as well as the concentration for each of those stocks. And you can see this by watching the Patreon exclusive. Any tier will get you this video. Check out patreon.com/firedupwealth. So in the beginning, I mentioned utilities, and I've talked about this company a few different times. This is located in the Midwest. They do have some wind power and some hydropower and things like that. This is NorthWestern Corp, and it pays you a 4.24% dividend yield, which is very attractive. P ratio is a 19. This was $63 on the high and 48 on the low. So again, on the high side, you probably want this closer to 55 or less. But I want to include this one because if you're looking for higher yield, it's a company that I do like. It's a small cap, $3.4 billion. Again, 4.25 on the yield, pretty attractive. NorthWestern Corp, it's a utility, ticker NWE. Now, if you're looking more for an energy play that's more focused, NorthWestern Energy, they do focus a lot on clean energy, and that's something that they're doing more and more of. But one that comes to mind, especially with younger investors, is always going to be NextEra Energy, so I want to include it. I've always thought this was too expensive at a 43P ratio. I'd rather buy NWE at a 19P ratio, paying me over double the yield, but it's one that always comes up. So I want to bring it up because it is one of those stocks that could have some more growth on the share price if you're holding it for 5 years versus NWE, where you're just getting yield. It's more of an income stock. So NEE, NextEra Energy, PE ratio 43, dividend 2.03%. A quick reminder, guys, I'm excited about this and I want you to join me. Join a leader higher. You can get access to the entire conference. Starting this Friday, January 6th, we're doing the Let's Get Fired Up virtual conference. 14 videos in 14 weeks covering all these topics. You can join Elite or higher. Go to patreon.com/firedupwealth. We're covering all this stuff on your screen here. Every one of these, and it's me as well as people from the community adding their perspective as well. These are going to be very high quality videos. You're going to have 15 hours of content over Q1 in 2023. So join us. Go to patreon.com/firedupwealth, join a leader higher, and get access to every one of the videos on your screen. And the last one here, it's one of my top 10 holdings. It's Abbvie. And I've done well with the stock. It pays you a 3.6% dividend yield, 21.53. It's going to be one of those healthcare stocks that generally holds up pretty well because of the high yield and things like that. There are some other ones you can look at, like United Healthcare, and there's different ones like BMY, Bristol Myers Squibb. There's several different healthcare companies you could include. But I like Abbvie. I like the dividend. I think it's going to do well for the next 5 and 10 years. I don't love it at $160 necessarily. It was in the 130s, 140s. Actually got down to 128 in January, but it's not terrible at 161 and 21P ratio. I would want this probably below $150, but I do like this one longer term, Abbvie. Please, guys, make sure you subscribe to the channel. Click that bell to get notifications. Drop me a like, drop me a comment. I appreciate your time and attention. Have a great rest of your day. Take care.